Mortgage rates, the pesky little thing that's derailing your home buying goals. When rates and prices are as high as they are, every little bit counts. So what can you do to ensure you're getting the best possible mortgage rate? Welcome to Dre's Take. Since 2022, when mortgage rates ballooned seemingly out of nowhere, buyers have been stuck in a holding pattern, waiting for rates to come down. We were promised multiple Federal Reserve interest rate drops in 2023 and 2024 that didn't quite pan out due to stubbornly high inflation. And so far it appears that 2025 is beginning to look awfully familiar, with most experts expecting mortgage rates to remain in the mid to high sixes throughout the year. Now, it's worth noting that the Federal Reserve interest rate and mortgage rates are not the same thing and aren't even directly related, sort of. Mortgage rates have more to do with how the bond market reacts to broader economic conditions. However, I like to think of the Federal Reserve interest rate as sort of the baseline. Since this is the rate that banks have to pay back to the Fed to borrow money, obviously the bank has to lend that money out at a higher rate in order to make the loan profitable. The interplay between the Federal Reserve interest rate and the bond yields create a gap where lenders make their profit. When that gap is wide, mortgage rates may vary more wildly from lender to lender. When that gap isn't so wide, then rates may not fluctuate very much at all between lenders, which is sort of where things are at the time of this recording. So obviously the first thing you could do to ensure you're getting the best rate is to shop around. Rates may not vary much from lender to lender at the current moment. However, some lenders may have lower origination fees or may have the ability to issue some lender credits towards what are called points, which is essentially prepaid interest that can be paid up front to effectively lower your mortgage rate. Now, the most effective things you can do in the current environment, however, are number one, improving your credit score. Obviously, your credit score is an indicator of your ability or willingness to pay back a loan, and the better your credit score, the better your rate's going to be. Next is to take control over your debt to income ratio. Paying down some debts and eliminating some monthly obligations can free up some income that makes you more desirable to lenders. The more freed up income you have to pay back the loan, the less risky you look to a lender. And in the eyes of a lender, obviously, risk is everything. So the less risky you are, the lower your rate's gonna be, whereas obviously the higher risk, the higher the rate. And finally, maintaining a stable or consistent work history. Again, consistent employment and income shows stability, and to a lender, stability equals less risk. So let's recap. Stable employment, low monthly debt obligations, and great credit equals less risk to lenders, putting you in the best possible position to shop around and make lenders compete for your business, ensuring that you end up with the best mortgage rate at the end of the day. If you don't know where to start, give me a call. I've got some great resources and lenders that can really help you gain control over these items. We can run some simulations to see exactly which debts are causing the greatest impact to your credit score and debt to income ratio, and really give you a clear path to understanding which items to attack to put you in the best position. Anyway, in the meantime, if there's anything I can help with regarding your real estate goals, feel free to reach out. I'm always happy to help. And until next week, that's Dre's Take. All right, y'all. Take care.